Take a second and scan whatever's within arm's reach, your phone. The screen you're watching this on. The Wi-Fi box blinking in the corner. The light switch you've flipped 1,000 times without thinking. Even the key fob that wakes up your car with one click. That's not the internet in some abstract sense. That's electrons obeying hardware. Billions of tiny decisions happening at insane speed. Every day, everywhere. And here's the part almost nobody connects. A shocking amount of that modern miracle leans on one specific element. Not lithium, not gold, not oil, not even copper. Silver, element 47. For most of human history, silver was money, minted, saved, fought over, treated like the backup plan when everything else failed. But in the last century, something quiet happened. Silver didn't disappear, it got reassigned. It moved from coin and vault into circuitry and infrastructure. Into the parts you never see but absolutely depend on. And once you notice that, you can't unsee it. Satellites, solar hardware, medical systems, data centers, the switches and contacts that keep the digital world from glitching out. Silver isn't nice to have. In the places where performance and reliability matter, it's often the difference between works and fails. So here's the question that should bother you. If our entire civilization is built on this metal being cheap and easy to get, what happens if that assumption is wrong? What happens if the real story isn't inflation or hype, but physics, because physics doesn't care about opinions. And you don't innovate your way around hard limits without paying somewhere else. In this video, we're not doing price predictions and we're not chasing next week's candle. We're going to zoom out and look at the next decade, the demand engine that's accelerating, the supply constraints most people misunderstand, and why the visible stockpile that actually matters may be smaller than the market is pricing in. This isn't a trade alert, it's a case file on the metal modern life can't run without. Pick up the device in your hand and look at it like an engineer, not an investor. Your phone isn't just glass and pixels. It's a dense, silent machine for moving electrons on command, through switches, contacts, solder points, circuit pads, and microscopic junctions that have to behave the same way billions of times without failing. Now look around your room. The laptop, the router, the light switch on the wall, the screen that never stops glowing. Modern life is not digital in some abstract, cloud-like sense. It's physical. It is electrified matter. And hidden inside that electrified matter is a metal the world still talks about like it's a hobby: silver. The real story isn't that silver is shiny or historic or undervalued by a chart. The real story is that the modern engineering stack quietly leans on one element more than most people can name. For centuries, silver lived in the public imagination as money, minted, hoarded, taxed, fought over, stored for hard times. Then something changed, not overnight, but methodically, as industry absorbed it. Over the last 100 years, silver didn't disappear, it got reassigned. It stopped being primarily a store of value sitting in vaults and became a utility metal embedded into the nervous system of a high-tech civilization. That reassignment matters because it changes the nature of demand at the deepest level. When something is valuable, people can choose to buy less of it. They can wait, they can switch preferences, they can follow fashion. But when an input becomes infrastructure, when it becomes part of the circuitry that makes systems function, demand stops behaving like a consumer trend. It becomes a requirement. The world doesn't keep buying silver because it's excited about silver. The world keeps buying silver because the machine breaks without it. That's not hype. That's how dependencies work. And once you see the dependency, you start noticing how invisible it is. No one celebrates the metal in the contact that keeps a grid stable. No one posts about the conductive pathways inside a panel or the reliability of a connector. The public sees technology and imagines software. The real bottlenecks live underneath, in materials and manufacturing choices that either conduct, endure, and scale, or they don't. This is why the script frames silver as something more specific than a commodity. It's not competing with copper or aluminum on a simple price chart. It's an enabler, a material that earns its place because its properties solve problems that are non-negotiable at scale. You can substitute on paper, you pay in performance in real life. You can cut corners, you pay in failure rates, heat, inefficiency, and brittleness when systems are pushed hard. And that's the investigative turn the narrative takes right at the beginning. Silver isn't a niche investment story. It's a dependency story hiding in plain sight. It's the metal quietly underwriting communication, electrification, and modern manufacturing while the public debates it like a collector's item. Once you understand that, the rest of the argument stops sounding like speculation. It starts sounding like an audit of the real world, an inventory of what modern life physically requires, whether anyone is paying attention or not. Once you accept that silver isn't just present in modern life but structural to it, the next question becomes unavoidable. Why silver? Why does this one metal keep showing up in the circuitry of a civilization that is obsessed with efficiency and cost control? This is where the story stops being about markets and turns into something colder, something that doesn't care what anyone believes. Because silver's real value isn't a narrative, it's physics, and physics doesn't negotiate. The periodic table is not a social media debate. You don't brand your way around it. You don't vote it up or down. When engineers choose materials, they are making trade-offs against hard limits: conductivity, resistance, heat, corrosion, reflectivity, durability at scale. And silver sits at the extreme end of several of those curves in a way that is annoyingly difficult to replace. Start with the one that matters most in an electrified world: moving electrons. Copper is the baseline, cheap, common, good, but silver is better. Not better in a poetic sense, better in the literal, measurable sense that it conducts electricity with less resistance. That sounds like a small advantage until you remember what modern systems are: billions of connections, trillions of switching events, enormous networks where tiny inefficiencies become heat, failure, and loss, in a device you hold in your hand, in a power system feeding a city, in any environment where reliability matters. The question isn't, can we make it work? The question is, can we make it work every time at scale? Silver is often the answer when the margin for error disappears. Then the script widens the lens beyond electricity. Silver is also framed as a light metal, one that handles photons with unusual efficiency because of its high reflectivity. That's why it appears anywhere precision, optics, and energy conversion collide. Light is not a vibe, it's a physical input. When you're trying to capture, direct, or manage it, you choose materials that behave predictably under stress, heat cycles, and long operating considered lifetimes. Again, this isn't luxury demand, it's functionality demand. The market doesn't keep pulling silver forward because it looks good and evolved. It keeps pulling silver forward because in critical places, contacts, switches, connectors, conductive pastes, high-performance interfaces, performance losses aren't just inconvenient, they're unacceptable. And that's the trap hidden inside the substitution argument people love to repeat. Yes, you can swap materials, you can make alternatives work, but the script's point is sharper. Some substitutions degrade performance so dramatically that the product stops being viable at the scale civilization demands. It fails in efficiency, fails in reliability, fails in heat management, fails in longevity, or fails in the economics of mass production. That's why silver keeps getting selected even when it's inconvenient, even when it's expensive, even when executives would love to delete it from the bill of materials. The math keeps dragging them back. Because if the world keeps electrifying, and it is, then the need for silver isn't a forecast. It's a consequence. Once you've locked in the first two truths, that silver is embedded in the machinery of modern life, and that its advantage isn't a story but a set of physical extremes, the next step is almost mechanical. What happens when the world decides to electrify everything at once? Because if silver is the premium conductor and a precision material where performance matters, then the demand curve isn't driven by enthusiasm. It's driven by deployment. And right now, deployment is accelerating. The script treats the energy transition as the main piston in that engine. And it uses solar as the cleanest example because solar exposes the logic in a way you can't hand wave. A solar panel isn't a green symbol. It's an industrial machine that takes photons and turns them into usable electricity. Day after day, year after year, across millions of rooftops and utility fields. That conversion is not magic, it's metallurgy and manufacturing. The panel has to collect charge and move it efficiently through conductive pathways. And the script argues that doing this at high performance relies on silver paste laid into fine conductive grids. In that framing, silver isn't a decorative input. It's a throughput requirement. If you want mass-scale solar deployment, you need a continuous river of the metal that can move electrons with minimal losses and survive harsh conditions. That's what turns silver into a bottleneck material. The limiting factor isn't just how many panels you can assemble, it's how much of the right conductor you can feed into the assembly line without degrading output. But the story doesn't stop at panels. Because the writer knows a single end market can be dismissed as a cycle. So the narrative broadens, and this is where the argument becomes heavier. Electrification isn't a product category, it's an architecture shift. It's power management systems in everything. It's grid upgrades that add switching, protection, and connections at every node. It's charging infrastructure, in public and private spaces, multiplying contact points and high reliability pathways. It's data centers, warehouses of compute that drink electricity like a living thing, then demand even more hardware to keep it flowing cleanly. And it's the steady, almost invisible explosion of electronics in daily products: more sensors, more automation, more control modules, more connectivity, more smart everything. Each device might use only a small amount of silver. But the script's point is ruthless. Units multiply. The world doesn't need 1 billion new machines. It needs tens of billions of new components inside billions of machines. When scale does that, small amounts become massive totals. This is the rhetorical mood that makes the demand story hard to escape. Silver demand is not a single wave you can surf and forget. It's layered. Even if one end market slows, if solar growth pauses, if consumer gadgets have a weak year, the base layer keeps expanding because the whole economy is becoming more electronics rich. Civilization is wiring itself tighter. And the more you wire a system, the more it depends on the materials that carry charge and endure stress without failure. That's why the script justifies the phrase, bigger than 1980. Not because it expects a one-time speculative frenzy. Because it's describing a structural pull, an industrial, multi-decade demand engine that doesn't need a silver boom narrative to keep running. It only needs the world to keep doing what it is already doing, building a future that runs on electrons. If the last point was that the demand engine is accelerating, solar, grids, chargers, data centers, and the silent multiplication of electronics, then the next question is the one that decides whether this is just growth or something more dangerous. What happens to that demand when price rises? In most commodities, rising prices act like a brake. People substitute, projects get cancelled, consumption gets delayed, the market self-corrects. The script's argument is that silver is built differently. Not emotionally, mechanically. Because the way silver is used makes demand unusually price inelastic, tiny per unit, critical to function. Here's the trick the narrative keeps returning to. Silver is rarely the headline cost inside the products that depend on it. In a phone, a solar panel, a connector, a high reliability switch, the amount of silver can be small in absolute terms, often grams. Sometimes fractions of a gram, yet those fractions are placed in the exact points where failure is unacceptable. That's why the script leans on everyday metaphors. Think of silver like a small ingredient that makes the recipe work. You can argue about the price of flour or the cost of the oven. But if the ingredient that activates the whole dish gets removed, you don't get a cheaper dinner. You get a ruined dinner. And if that ingredient doubles in price, the total cost of the meal barely moves. The manufacturer doesn't stop cooking. They pay the new price and move on. Because the real expense is the assembly line, the labor, the distribution, the warranties, the brand risk, the downtime, everything that happens if reliability slips. That's the core of inelasticity in the script's thesis. Silver's share of cost can be small even when its share of performance is massive. When engineers specify silver in a contact or conductive layer, they're buying reduction of losses, reduction of heat, higher consistency, lower failure rates, and longer service life. Those outcomes are worth far more than the metal's line item on a bill of materials. So the usual market discipline, price goes up, buyers disappear, doesn't bite as hard. Buyers don't vanish because they aren't buying silver as a discretionary good. They're buying it as a reliability input. They're buying it because the system must stay on. Now connect that to the demand waves you already established. Solar doesn't get built because a consumer feels like it. Grid upgrades don't happen because a household wants a luxury. Data centers don't expand because the internet is a fashion. These are infrastructure decisions, and once they're underway, they behave like commitments. If the price of silver rises, it doesn't automatically stop a utility-scale build-out or the manufacturing of millions of devices. The script's claim is blunt. Substitution is limited, because physics. And demand destruction is muted, because silver is a small but essential input. So the market can remain tight even as price rises. Because the buyers keep showing up, not because they love the price, but because they can't afford the alternative. And this is where the logic becomes a trapdoor. If demand doesn't back off easily, and supply can't respond quickly, the balancing mechanism isn't more production next quarter. It's repricing, potentially violent repricing, not as a prediction, but as a structural outcome of a market where the critical input is small, necessary, and hard to replace. The script is building toward a simple conclusion. When industry behaves like a forced buyer, silver doesn't trade like a normal commodity. It trades like a bottleneck. And here's where the script tightens the trap. If demand behaves like a forced buyer and won't back off cleanly, the textbook response is supposed to come from the other side of the market. Supply rises to meet price. That's how most people imagine commodities working. Price goes up, miners rush in, production ramps, the shortage fades. But the argument pivots on a detail that flips that intuition on its head. The kind of most people don't know this fact that changes the entire mechanism. Most silver isn't mined as silver. It's mined as a passenger, a bonus stream, a byproduct captured while someone else is actually driving the car. Much of the world's silver comes out of operations whose real business is lead, zinc, copper, or gold, metals with their own cycles, their own margins, their own constraints. Silver shows up in the ore, gets recovered in the processing chain, and then gets counted as output. But it is not the primary decision variable. And that distinction matters more than any chart because it means silver supply is not fully price elastic to silver. In plain terms, even if silver price spikes, a lead zinc producer doesn't instantly triple throughput just because silver got hot. They can't. Their mine plan is built around the primary metals grade, recovery, and demand. Their permits and environmental limits aren't written for silver mania. They're written for a certain tonnage of rock and a certain processing capacity. Their mill can only grind so much. Their smelter contracts have fixed constraints. Their capital budgets are approved years in advance. Their executives answer to the economics of the main product, not the byproduct credit that shows up as a helpful line item at the end. This is the built-in handcuff. The market wants to believe higher silver prices automatically summon new silver supply. But a huge portion of the supply chain is chained to other metals' economics and bottlenecks. Silver can scream. The system may barely turn its head. That's why the script frames the market as lacking a true swing producer, no single region or set of operators that can flood the market with ounces on demand the way certain players can in other commodities. The steering wheel isn't directly connected to the wheels. The driver can crank the price signal, but the machine responds slowly, indirectly, and sometimes not at all. Put that next to the inelastic demand you just established and the asymmetry becomes the point. Industrial demand can rise quickly. New factories come online. Deployment curves steepen. Electronics multiply. But mine supply, especially byproduct supply, moves like a heavy ship. Slow to turn, slow to accelerate, partially indifferent to the very price signal people assume controls it. That's how deficits persist without an automatic rescue. And that's why the script leans toward the language of a cliff, instead of a gentle rebalance. A system can drift into shortage quietly when the supply lever you think exists is, in reality, bolted to someone else's cycle. Once you understand the byproduct handcuff, how a huge slice of silver supply is chained to the economics of other metals, the next layer of the problem lands like a second lock on the same door. Even the mines that do chase silver directly are fighting geology. And geology doesn't care what price you put on a screen. The script sharpens this with a simple, brutal trend. Ore grades are falling. That phrase sounds technical, almost boring, until you translate it into what it actually means. A lower grade is not just less silver. It's a multiplying burden. It means you have to move more rock to get the same ounce. More rock means more drilling, more blasting, more hauling, more crushing, more grinding, more tailings, more diesel, more electricity, more water, more parts, more labor, more maintenance, more everything, just to stand still. The cost isn't linear, it stacks. And as grades decline, silver becomes increasingly energy-intensive and capital-intensive in a world where energy, capital, and permits are not getting easier. This is where the script forces the viewer to abandon the fantasy of quick fixes. People talk about new supply like it's a tap you can open. But a mine isn't a warehouse. It's a living industrial system anchored in physical terrain, regulatory reality, and long timelines. Before a single commercial ounce comes out, you need exploration and confirmation. You need feasibility studies and financing. You need environmental reviews, water rights, community negotiations, and permits that can take years. You need roads to nowhere, power lines, camps, mills, processing plants, real infrastructure that has to be built, tested, and stabilized.
Next decade
you don't flip this on in 6 months because the spot price is exciting. And even if you had approval tomorrow, you still have physics and logistics, equipment-led times, skilled labor constraints, construction seasons, commissioning problems, ramp-up curves. Mining is slow because the planet is slow and the systems around it are slow. That time lag becomes the persuasive knife. The script's underlying line is basically this: if it takes roughly a decade, often more, to bring major new capacity online, then a big portion of the next decade's supply is already locked in by projects that are being built right now or are far enough along to be inevitable. And the punchline is that there aren't enough of them. That converts a messy industry reality into a clean conclusion anyone can feel. The world can want more silver. But geology, permitting, and time won't cooperate on demand. You can raise the price signal. You can shout into the market. But you can't negotiate with the depletion curve of mature mines. And you can't speed run the physical construction of a new mine without paying somewhere else, in safety, reliability, cost overruns, or outright failure. This is why the phrase, supply cliff, isn't just drama in the script. It's an emotional anchor for a structural timing mismatch. Old mines deplete, grades decline, replacement projects arrive slowly and in limited number. Meanwhile, demand is accelerating now, today, driven by electrification and industrial throughput. That mismatch is the point. Meaningful supply relief, even in the best case, shows up too late to prevent the near-term squeeze. So the market starts drawing down what it can draw down: inventories, stockpiles, the visible pool of ounces that can be mobilized quickly. And once that buffer shrinks, the balancing force isn't more metal next quarter. It's price repricing, because the system has run out of other levers. If the supply cliff is the slow motion problem, declining grades, long build times, and a decade of capacity that's already effectively baked in, then geopolitics is the fast motion problem. The one that can tighten the market overnight without asking permission from geology or spreadsheets. Because once you realize supply is constrained by physics and time, the next uncomfortable truth is that it's also constrained by borders. The script introduces geopolitics as the third stressor, not to add drama, but to show how fragile the system becomes when the remaining supply isn't just scarce, it's concentrated, exposed, and routed through choke points that can be disrupted by policy. Critical metals don't move through a vacuum. They move through jurisdictions, customs, smelters, contracts, and shipping lanes. And when a large share of global silver output is tied to a limited set of producing regions, often through byproduct streams attached to large base metal operations, you inherit the political risk of the primary industry and the country that hosts it. A lead zinc mine doesn't just wake up one morning and decide to double production for silver. It answers to regulators, labor rules, energy prices, export policies, environmental constraints, and the political mood of the nation-state it operates inside. That's what makes the supply chain vulnerable in a way most investors don't model. The ounces aren't just in the ground. They're in systems, and systems can be interrupted. Now imagine a policy shift, a new tax, a tighter environmental restriction, a labor dispute, a currency crisis, an export control, a crackdown on smelting emissions, or a trade dispute that turns a normal flow into a constrained flow. None of these need to end mining to matter. They just need to slow throughput. They need to delay shipments. They need to complicate refining or reroute supply through less efficient channels. That's enough to tighten a market that was already operating with thin slack. The script's point isn't that disruption is guaranteed tomorrow. It's that the system is built in a way where disruption matters more than people assume, because the cushion is smaller than the headlines imply. And that's where the argument gets sharper. The visible silver market is portrayed as hand-to-mouth. Unlike some commodities where governments maintain large, transparent reserves that can be mobilized in a pinch, silver is presented as lacking a comfortable strategic buffer, at least in the channels that actually feed industrial and investment demand. When the buffer is thin, shocks don't get absorbed, they transmit. They show up as delivery stress, widening spreads, sudden premiums, and price gaps that feel irrational to anyone watching a tidy two-decimal quote. This geopolitical layer functions as a multiplier on everything you've already established. Even if you're optimistic about mining investment, even if you believe recycling can improve at the margin, geopolitical risk means the market can still experience discontinuous constraints that overwhelm normal planning. Demand is distributed globally and embedded in essential tech, phones, grids, solar, compute. Supply is concentrated and vulnerable. That asymmetry is the underlying pattern the script keeps hammering. Silver is a strategic input masquerading as a boring commodity, until the first real shock reveals what it actually is. After geology, timelines, and geopolitics, a reasonable skeptic reaches for the last comfort blanket. The one people always pull out when a resource story gets uncomfortable: recycling. Fine, the argument goes, maybe new mines are slow, maybe supply chains are fragile, but we'll just recycle what we already have. And this is where the script turns the knife with one of its cleanest conceptual contrasts. Because it insists recycling won't rescue silver the way it rescues gold. Not because recycling is impossible, but because silver doesn't behave like a hoarded metal. It behaves like a consumed one. Gold is money in the most literal, physical sense. It sits. It waits. It accumulates. It is dense value that people protect, pass down, and melt back into bullion when needed. Gold circulates through the economy and returns. Silver is different because it lives in two worlds at the same time. Yes, it can be money when it's held as bullion. But in the industrial age, it also became fuel, an enabling input embedded into products that get used, worn, shredded, discarded, and forgotten. The script frames this as the hidden tragedy of above-ground supply. Humanity has mined staggering quantities of silver across history. Yet the identifiable stock of bullion is portrayed as only a small fraction of what was pulled out of the earth. The implication is stark. Most of the metal didn't vanish into a vault. It vanished into dispersion, scattered across landfills, industrial waste, and microscopic layers inside billions of devices. That mechanism has a name, and it's colder than any market narrative: entropy. Concentrating metal into a bar takes energy and intent. Dispersing it takes almost none. Once silver is smeared into thin films, conductive pastes, contact layers, solder points, and tiny components, it stops being a treasure and becomes a trace. It's not that the silver isn't there. It's that it's there in the worst possible form for recovery, tiny amounts in countless places. Mixed with plastics, ceramics, adhesives, and other metals, buried inside products designed for performance, not for easy disassembly. The script uses history to show this isn't hypothetical. Photography was the early wave, silver consumed in chemical processes and scattered. Electronics are the modern wave, and arguably the worse one, because the scale is larger and the silver is distributed even more thinly. This is why the recycling story runs into a brutal economic wall. You can recycle silver, but the question is not can. The question is, at what price? At what throughput? And at what energy cost? If you need to process massive volumes of e-waste to recover small grams, the economics don't work unless the price signal becomes extreme or the recovery technology becomes radically cheaper and more scalable. Otherwise, the metal remains effectively trapped, present, but inaccessible at market speed. In the script's framing, industrial silver is a one-way street. Mine right pointing arrow, factory right pointing arrow, device right pointing arrow, landfill. Not because everyone wants it to be that way, but because the system is optimized for manufacturing efficiency and